Look at all the people who bought silver during the silver squeeze that got pissed off because it didn't do what they thought it would. And that's cartel work in action, where they held it down when it really, if price discovery would have been allowed to happen without 8 banks holding the largest concentrated short position in the history of the COMEX, well, then the price would be much higher. But you can see that's now broken because the LBMA has the lowest silver float, 155 million ounces, that they've ever had, ever. That's 1 day worth of trading. And we're supposed to believe that it's a shortage of trucks and manpower why people can't get their bars for 8 weeks. As you can see, they've been caught with their pants down, and they're this close to the whole thing breaking. Silver and platinum are the number 1 and 2 most shorted commodities on the COMEX market. And it seems like, and again, I don't want to get too excited because we've been through this so many times, the little boy who cried wolf, we always know that the wolf does come. But it seems like the paper futures market prices are kind of disconnecting from the physical prices after all of these years. And what you're seeing really are traders rushing to secure physical metal, possibly to avoid, risk if physical shortages worsen. First of all, obviously, this is a very bullish environment for metals and could trigger more volatility. But in general, what we're seeing in silver is different than anything I've ever seen in this marketplace. So you have a guy named Daniel Gali of TD Securities, where he argues that the outflow of silver caused by the tariff arbitrage, and I don't think it's just a tariff arbitrage, that's what they want us to believe, has left inventories of freely available silver critically low. In fact, the LBMA, the London Bullion Metals Association, silver free float now stands at the lowest level in recorded history. So this is the most influential silver market on the planet, the LBMA, and it's at its lowest level of silver holdings ever. We've talked about this, done again ad nauseum, the drawdown in silver off of the exchanges. And he writes, the so-called free float of inventory at the LBMA has dropped to just 155 million ounces. That's less than a single day's worth of trading volume for spot silver in London, and it makes an unprecedented squeeze in the world's most important silver trading hub. The result is a dramatic spike in the cost of borrowing silver, with 1 month lease rates soaring as high as 8%, and a level almost never seen in this market. If you have to pay 8% to lease the silver in order to cover a position, you're in big trouble. And, David Jensen, who does a masterful job of talking about what goes on in the LBMA, says that they're actually trading about 1.9 billion, with a B, ounces per day, 3.5 times annual global mine supply, and in this case, well over 10 times the float every single day. Now, he says that they trade roughly about 190, 200 million ounces or somewhere in that neighborhood, but those numbers are 10 times understated, as they only post the final settlement number. So when you're trading, in essence, pretty dang close to 2 billion ounces a day, and you only have 155 million ounces backing it, what could possibly go wrong? And that's the situation where LBMA has gone from T+1 to T+8 weeks, citing a shortage of manpower and trucks. Couple other things we're talking about. The last week's COT report, or this week's COT, Commitment to Traders report, just came out on Tuesday. And it's interesting. It shows that the commercial banks have 79,600 contracts net short. That's about 404 million ounces. The interesting thing is that they built this short position at or around $37.50 when they dumped a whole bunch of silver short. But now silver's over $39. These traders are freaking out, and they're bleeding hard. That shows let's see here, a silver about $2.50 higher. That would be a paper price loss of pretty dang well near $1 billion in 3 days. So not only has the silver price hit its highest mark since 2011, the banks have just set a new record for the largest short position ever in the history of the COMEX market, ever. And they're underwater $1 billion in 3 days. Now, the silver EFP, which is the exchange for physical, surged by 250% in the last couple of days. What does that mean? That means that it's the cost to swap physical silver for futures has skyrocketed by 250%. This increase would signal massive stress in the silver market. It means that traders are scrambling to find any silver they can, which is in short supply on that level. And this is a major move that would typically only reflect massive tightness in the physical market or a lack of trust. And that's a scary thing. So you have skyrocketing lease rates. Lease rates are between 6 and 8%, very high. And by the way, platinum lease rates just popped up to 18%. That's extremely high. It says extreme tightness and extreme demand for physical to metal. You also have the gold EFP rates that just jumped up $4.50 just yesterday. That's another sign of dislocation and demand for physical delivery. So when you got gold and silver and platinum lease rates blowing up, you have the exchange for physical rate blowing up. You have the T+1 going to T+8 blowing, or 8 weeks blowing up, and on and on and on. This is a sign that we hadn't begun to see where this market ultimately goes. And you know, you have these big traders that are heavily short and expecting prices to fall, but the market goes the other way. It's a scary thing. And at the same time, you have all these premiums jumping. This has to have the banks rattled. A couple other things that I noticed over the weekend. David Bateman, are you familiar with who that is, Dunnigan?
I haven't followed him.
He's a billionaire, and I want to read something to you because I think it underscores some big money, right? So we've talked about that since the beginning of the year. The insiders, the institutions, the institutional traders have been selling equities every single week. Since June, they've been averaging about $2 billion a week selling. At the same time, ma and pa retail investors have the largest allocation ever to equities. It's even greater than the dot-com bubble. So what could possibly go wrong there since the beginning of the year? 6 sales, 1 buy by the insiders who know the trajectory of their business. None of that's good. At the same time, you have on the COMEX level and the LBMA level, which reeks of sophistication and inside info and money, they're ripping metal off the exchange at a level that's never been seen before, the lowest level of silver ever in the history of the LBMA, and the largest deliveries ever off the COMEX. Not a good thing. That's done by institutional traders. On our level, me and you, we see most of the retail public has no idea what a gold or silver coin is. So you look at the dichotomy. The insiders are selling equities and buying commodities and standing for delivery, while the retail public has nothing in the way of commodities and is all-time record in equities.